What up, nerds? My name is Luke. I help people interested in crypto get some returns on their savings and grow their wealth through the power of DeFi. So today I'm going to talk about a strategy that you can do in the DeFi markets that works pretty good right now when we're in a bear market, when the opportunities for yields and returns are pretty low. But of course, this is a pretty good strategy at all times, even during a raging bull market. So let's get started. What is lending arbitrage? Well, in DeFi, there are plenty of places where you can lend out your capital or borrow at variable interest rates. So you have many different protocols, many different platforms where you can put your capital to work. And because of this, you have lots of different interest rates for the same token. This is because a lot of these are determined by supply and demand. So one platform might have very high demand and very low supply, and thus the interest rates are really high. And similarly, on a different platform, you might have a lot of capital and not much demand, and then therefore the borrowing rates are quite low. So simply the strategy is to borrow a coin from some market where the interest rate is low and then lend it on a different market where the interest rate is high. And basically you're just profiting off the difference. So if you can borrow at a rate of 0%, that'd be pretty good. And then you lend it out at 8%, you immediately make the difference, which is 8% on your coin. And it's an arbitrage, meaning that there's no really market risks, and it's the kind of risks and things that you're taking is going to be platform. We'll see that in a moment. So how do I do this? Where do I find these? So let's have a look at where you might find different lending markets. So this is DeFi Llama. Great website. If you don't know DeFi Llama, then just search up defilama.com, put it in your bookmarks. This is a great resource for DeFi. Has all the platforms, has different stats and things. So what you do is you go to this website, go up here to find specifically DeFi, and you look for specific categories. So let's click that. And now we go to lending. It's actually one of the most popular types of protocols out there at the moment. So we'll click lending. And now you have a big list of all the different lending platforms. So what you want to do is you want to find one chain so you can easily transfer the coins between them. So let's go for Optimism. This is one I'm currently looking into a lot. And here you have some of the major lending protocols. As you see, Aave is the top one. Pretty much the largest by quite a mile. It's like 150 million on Aave, and all the rest are a little bit lower. So specifically for the strategy I'm going to show you, I looked at this earlier or yesterday, and I had a look at Iron Bank. And Iron Bank's pretty good because you have some pretty good rates on the lending side, and also you have some different tokens that you can borrow, like OP. OP is not on Aave, so that's why particularly I'm looking into this one. So right now, as you can see, OP is around 9%. And another lending market is Taro. Now this is a little different from Iron Bank or Aave, which are money markets where you have one side for lending on the supply side and one side for borrowing. But Taro is actually a platform where people can leverage their LP tokens, and to do this they borrow other people's assets. So you can lend your own assets up on here to get a return that people will pay you. So some leverage LP, or we're going to pay you some variable interest rate. And this is nice because you have many different tokens that you might not see on a normal money market. So let's have a search for OP. Okay, this gives us all the different isolated pools where we can lend our OP and the different interest rates. And as you can see, the biggest one right here, the OP USDC pool, actually has a supply APR, meaning if you lend this out, you're going to get around 41%. That's pretty high. So here's a strategy. Simply put, we put in USDC up here. We get around 4%, 4.5%. We borrow our OP at 9%, lend it here at 41%, and we try and get that difference, which is 32%. So here's all the returns and the costs of each. Now I actually did this yesterday, so the returns are a little lower than what they're showing right now. So I saw that you can lend USD at about 3.3%. You can borrow. So the strategy will be we're going to borrow 60% of how much we lent out of USD in Optimism token, and that was at 10%. That was yesterday, it was at 10%, now it's at 9%. And then we lended out the entire amount of the OP on Taro for, yesterday was 28, now it's actually 40. So the return of the strategy has actually gone up. All right, so we know what the returns are, we know what the costs are. What is the risks? Now, of course, the biggest one is platform risk. That's almost always going to be your biggest risks, and probably the first thing you should think about. So on Ironbank, platform risk, I said it's about 7.5%. Now, I've got this figure from a insurance protocol called InsureDAO, and then I just took half the premium you'll pay is what I signed for the platform risk. Now, you might think that the platform risk is higher or lower or, whatever. It's kind of up to each individual to try and put what they think is. So platform risk to me essentially means that that's the probability that some issue is going to happen and your entire investment on that platform is going to go to zero. So that could be smart contract bug, it could be a hack, it could be a rug. The platform owners could just do something in the back end to just completely rug everyone, take everyone's money, all sorts of things like this. The second risk on Ironbank on the lending side is you have a chance of liquidation. Your collateral can get liquidated if the price of OP increases too high. So right now, I think you can have a collateral ratio, meaning you can have up to 85% of the value of your collateral borrowed. And because we're aiming for about 60%, that means that if the price of OP increases by 40%, and we don't, rebalance such that we're not going to get liquidated, but if it increases over 40%, then we get liquidated and we lose around 10% due to a liquidation fee. So I've assigned this about 1% of the time this is going to happen, because these moves, right, you can check this. You can see every day if it's going closer to that. So you're kind of really worrying about a 40% overnight move. And I assigned about 1%. Taro, platform risk is about 5%. Again, this was from half the premium of an insurance protocol called InsureDAO. And finally, the last risks is related to, rather than a loss, it's related to the expected return. So our return is directly proportionate to the price of the OP token. And why is that? Is if the price increases, then the interest that we receive relative to our USD actually goes up. So as the price is increasing, we are making more return, higher return. Similarly, if it goes down, we're making less return relative to our USDC. Similarly, the interest rates could change because they're floating variable interest rates. If the interest rate on Ironbank becomes higher than Taro, then now we're actually losing money on a position. So these are different return-based risks to think about. Okay, so how do we account for all this? How can we tell, right? It seems like it would be very, very profitable, but how can we tell if it actually is profitable or not? So what you want to do is a quick back of envelope expected value calculation. And this is it. So don't be too worried about what this is, this mess of an equation. So effectively, this is just in numbers what we were looking at right here. So it includes platform risk, it includes the risks of both platforms going to zero, and the market risk. So let me break this down for you. So the second part of this equation, we're basically saying that, as you see here, about 7.5% of the time, this is this part, 7.5% of the time, the Ironbank is going to get hacked, right? And when that happens, 5% of the time, the Taro also get hacked. And now if that happens, we end with zero. So that's what we're seeing here, 0 multiplied by the 5% chance that happens. Now, when Taro doesn't get hacked, the other 95% of the time, we actually make a return on our Optimism, which is 60% of our collateral. But because Ironbank has been hacked, we lost that collateral. So we actually lost 40% of our position. So that's that part. Now, when Ironbank isn't hacked or no other issue happens, 92.5% of the time, we might get liquidated 1% of the time. That's that part. And then 99% of the rest of the time, again, we have to split by when Taro is hacked and not hacked. And here is when everything goes right. This is, we get the return on USDC. That's pretty good. We get the returns on our OP. Pretty good. And then 5% of the time, Taro gets hacked. We get returns, but then we lose the 60% of our position. And overall, now when you add all this together, when you take this kind of EV sum, you end up with around 7.1%. So the expected value is 1.071 in a year's time. So that's pretty good. I mean, that's a pretty good return on something that's effectively market neutral. And actually, if we take this equation, let's take this and see what it looks like, given that the returns are a little higher. So let's take this whole equation. All right, copy this, put it into Google here. All right, put a little plus here. All right, so what we saw was instead of 18%, we're actually getting 32% on the difference, which is pretty nice. And I think that's everything. Oh, and also we were getting a little bit more here. We were getting 4%, I believe, or 4.2% or something like that. So we'll just put that in. 4.2% on the USDC. Okay, so let's have a look. And that seems pretty high. So that's pretty good. So 15, almost 16%. So now our lending arbitrage strategy on OP is 16% on USDC. So that's really, really good. That's the kind of return that you should be aiming for. Now, one caveat to this is actually assuming that the position is just locked for the entire year. And so I kind of did a little bit of a simplification to kind of give you an idea of if it's profitable or not. Because we're kind of looking at, okay, if we hold this for an entire year, what's the return we're going to get? But of course, it doesn't really work like that. If we get hacked or we get liquidated or something happens, we're not just going to hold it for the rest of the year making zero return, right? We're going to redeploy that capital. So maybe a better way would be to look at this instead of over a year return, look the EV, a weekly EV. And then you can just, compound that, kind of look at the geometric average, the compounding rate from the week to the year to kind of give you a better feel for how much it actually would be. And in most cases, probably that would actually be over the stated 1.7 here or the 16% that we just calculated. I didn't do it because it's a little complicated. People see the APR as a little easier. It's easier to see an APR on the platform. Similarly, when we're thinking about risks and stuff, the yearly kind of returns are a little easier to deal with. But if you were doing this yourself, probably better to using on a smaller time frame. However, how often you check your positions, how often you can easily move these things around, let's say it's once a week, then you should probably consider these weekly. So finally, some comments, right? The 7% EV that we're looking here, that would be if we were lending on Taro. Now, considering that there's a 5% chance that Taro just goes bust over the next year, that's actually equivalent to around 12.7% APR on USDC on lending. Now, that's a very high figure. You're very rarely going to see this over the course of a year. If you do, that's great, right? But usually it gets arb down or people lend and it kind of reduces again down to around 5% or so. So this is equivalent to that. Now, the thing is, if you do see that, that would be a strictly better strategy because the risks might be slightly lower. And the final comment is there is a non-zero chance that you can lose the entire investment. Now, it's actually pretty small. If you see here, the chance of losing everything is 7% multiplied by 5%. So that's less than 1%. Like that's even less than maybe 0.1% of the time you're going to lose everything. However, there is a chance that you lose everything. And then whenever there is, you do not put your entire portfolio on this. I mean, that's why in most cases people say, don't go all in on one protocol. I mean, we just saw with the FTX fiasco, right? If you had your entire net worth on FTX, even if the probability was really small that this would happen. Like, no one was expecting this to happen. But even if the probability was only 1% chance that this happen, you should never ever put everything on if you can lose everything in one. So always diversify across these platform type risks. It's one of the major things to take away. So I hope that gives you an idea of how you can take this strategy, how you can go find different lending arbitrages yourself, how to calculate or think about if they're profitable, and just different things to consider when doing the strategy and just working through DeFi, particularly in this bear market. So like and subscribe if you found anything useful or anything interesting, and stay tuned for more content.